Hey guys, this is David with this week's Friday Fresh Take. This week I want to talk about loan assumptions, and it's a tool that we haven't really been using a lot, but we've started to push into recently as a really great tool to help our clients with the tricky situation that we have right now with interest rates. So again, loan assumptions, it's not a tool that we've been using quite a bit in the past, largely because of the last 2, 3, 4 years, interest rates have been so low people haven't really had an issue with the current interest rates. Now, with interest rates going up so much, 6, 7% interest rates, it's been an interesting tool to help our buyers still get a home for at or below list, but start to get a really great interest rate as well. So a great example is just the other day, we actually had a client that was able to negotiate a home $125,000 lower than the original asking price, and they got a 3.25% interest rate on that. Super awesome, great deal, right? That's what we're talking about. So let's dive a little bit more into assumptions, the nitty gritty, and like how these actually work. So a few years ago, let's assume somebody bought a home for 3 or 4% as far as their interest rate. Now they've been living in that home for a few years, they've been paying down their mortgage, and for one reason or other, they need to move. They put that house up on the market, and if the loan is assumable, you as the buyer can now come in and you can take over their mortgage. So instead of getting a new loan for 7% interest, you can take over their mortgage and their loan with the current terms that it has. So there's goods and there's bads to this. I mean, you take on the same interest rate, the same loan amount, the same loan term. So all of those pieces stay with the loan. Where this gets a little bit tricky is figuring out how to cover the down payment. So let's talk about a specific example just to put some numbers to this. Let's say somebody bought a home for $400,000 just a few years ago, right? They got a small loan on it, $385,000 in the loan. And over the last couple of years, they've paid that down. So now the remaining loan is $375, okay? $375 is what's remaining on the loan, but the property has appreciated quite a bit. As a lot of properties have nowadays, it's gone up and now the value is at $500,000. So what you as the buyer would be looking at is you're taking over the $375,000 mortgage, and that's a great situation. But what you have to do is you have to bring cash to make up the difference between the $375 and what they're selling it at $500. So as you can do easy math, it's about $125,000 difference that you'd have to bring for your down payment. Now, not every situation is like that. That's a larger down payment situation. But the tricky part with these loan assumptions is that you do have to find one where the down payment needed to make up that difference fits what you've got to bring to the table. So that's kind of one of the trickiest pieces of this whole process. Now, every situation is a little bit different. And also, not all loans are assumable. That's probably the other tricky piece, is it's not really easy for the consumer to identify properties that are for sale, which loans are assumable, which loans aren't. There are even some homeowners that don't even know which loans are assumable. So on the buy side, I say the best thing is just let us know if you're interested. We can actually do some pretty cool tricks to identify. Right now, there's about 75 to 100 properties around the metro area that are available to have loans assumed, and we can quickly search and identify those. On the sell side, if this is something that you're curious about, let us know. Say, hey, we're thinking about selling our house. We'll reach out to the lender. We'll identify if the loan can be assumable or not. And then we definitely would want to advertise that because it makes your house more appealing to potential buyers. So give me a holler if you have any questions about this. Great tool that we should definitely be using in this market, especially with high interest rates. And other than that, we'll see you next time. Cheers.